It's almost like you have to slow the game down, like they talk about baseball speeding up on you. You need to slow it down. I can buy this thing for a huge fraction of what it's worth. What am I worried about if it goes down a little bit more?
Seth Klarman is a billionaire investor and the CEO of Baupost Group, and the fund has generated an average annual return of 19% since its inception in 1983. He considers himself a student of Warren Buffett and invests in a very, very similar way by focusing on companies with durable competitive advantages that can be purchased at a reasonable price. Seth Klarman and his fund underperformed the market in 2019, and he cited the lack of investment opportunities as one of the primary reasons as to why he underperformed the market and why he was in 30% cash at the end of 2019. But as we sit here in mid-2020, we now know that they have used a significant amount of that cash position to invest in two very large and very well-known companies, that being Alphabet or Google and Facebook Incorporated. And the reason why we know about these investments in Facebook and Google, which were made by Baupost and Seth Klarman in the first quarter of 2020, is due to an SEC filing called the 13F, which is a requirement for funds that have more than $100 million of assets under management. The 13F SEC filing discloses all of the equity holdings of these big fund managers, and as a result, we can compare the equity holdings in this quarter to the previous quarter to see if a fund manager managing more than $100 million is making any significant moves in the market. And that is what we are able to see with Seth Klarman and his fund's 13F filing. So let's quickly jump over to the 13F filing for Baupost Group and have a look at how it has changed since the last quarter. Now, these forms can look intimidating, but there are a couple of major things that we are looking for when we're looking in a 13F. In column 1, you can see the name of the security that is in question, the name of the stock. In column 2, it is the type of class, so whether it's a common stock, which is a typical share, or whether it's a note and it's a bond or something like that. In the fourth column, we are looking at the total value of the investment, the cost of the investment for this fund. And in column 5, we are looking at the number of shares that they were able to purchase. And when we compare the 13F filing from the fourth quarter of 2019 to the first quarter of 2020 for Seth Klarman's fund, one notable standout is the addition of Facebook and Alphabet in this fund. And if we move over to column 4, we can see that Alphabet is a position worth $350 million and the Facebook position is worth $330 million. So from the 13F filing, we can see that Seth Klarman initiated quite substantial positions in both Alphabet, Google, and Facebook. And if we take the total cost of each investment and divide it by the number of shares that they acquired, we can get a gauge for the average price that Seth Klarman paid for both of these investments. And the average price that Baupost Group and Seth Klarman was able to pay for their Alphabet shares and their Facebook shares was $1,162 per share for their Google shares and $167 per share for the Facebook shares. And the final statistic that I will throw at you from these 13F filings that is important to know is what percentage do each of these make up of their overall portfolio. So their Alphabet shares make up 5.2% at the time of the 13F filing, and the Facebook shares made up 4.9% of their total portfolio. So this bet on these two digital advertising businesses makes up about 10% of their overall portfolio. So the next logical question is, why do I think that he invested in these businesses? What do I think that he sees in these companies? And I think that he's making a significant investment, a significant bet on the digital advertising, the online advertising industry, because basically Google and Facebook dominate the online advertising industry. It's basically a duopoly between those two, meaning that there is very little competition outside of those two businesses. And while it might be difficult to determine which one is going to grow faster than the other, I don't think it takes much to believe that as a group, those two businesses are going to be very, very dominant in the digital advertising space over the next decade. Online video and social media ads have grown at high double digits for quite some time, and that growth is likely to continue, with hundreds of millions of people coming online for the first time in India and other emerging markets every single year. And on top of that, digital advertising is still so undervalued by businesses. It's actually ridiculous how cheap running an online ad on Facebook or on YouTube or on Google search is compared to running something from a traditional media source, such as a television commercial or a newspaper ad. Those advertisements have terrible conversions. It's very difficult to know how many people have seen your ad versus how many people purchased your products, whereas doing that on Facebook is so easy. You can see exactly how many people saw the ad, how many people clicked on it, how many people went around your website, how many people purchased, and how many people came back and repeat purchased. And having that information allows you to save so much money as a digital marketing agency and for businesses which are looking to advertise their products and, of course, make profitable investments in advertising. Spend $1 on advertising and make more money back in revenue. So what I see in this industry is an industry that has two dominant players, very little competition outside of those two businesses. I see both of them in a very high growth industry, so they don't need to compete against each other too much for new advertising revenue. They're going to be able to capture that advertising revenue from the growth of the market overall. Both companies have huge amounts of cash on their balance sheet, and Facebook has zero debt and Google has very, very little debt, which means that they are both in very, very good financial positions. And as you can probably tell, I'm pretty bullish on this industry, and as a result, I have made an investment in Facebook a couple of times in the past. The first time that I invested into Facebook was in late 2018. This was when all the Cambridge Analytica stuff was going on, and stuff about the election tampering and that sort of thing. And basically, the stock price for Facebook went down 40% throughout a year. That was when I made my first investment, relatively small, and I made another investment that was a little bit bigger than the first investment into Facebook during late March. So let me just sort of lay out to you my case for Facebook and why I think it is such a compelling investment. Firstly, in terms of their advertising business, which at the moment is 90% or more of their total revenue, I think that we could still expect that business to grow at either high single digits or low double digits over the next decade. And that's basically going to come significantly from growth in the industry, growth from emerging markets, as well as just in developed markets that are still seeing people consume more and more content online, either through social media, which is where Facebook would benefit, or through searching and information searching, which is where Google would benefit on YouTube and Google search. I then also think that Facebook is going to be able to grow significantly in the payments industry. And I don't know to what extent they're going to be able to grow because they haven't really established themselves at all. But I think that they will be able to generate some revenue in that industry. And they made a significant move in that industry recently. I think it was a couple of weeks ago. They invested a 10% stake into the largest telecommunications company in India. And that telecommunications company was responsible for bringing online about 400 million people in India. So bringing 400 million people onto the internet for the first time in India. And as a result, some of those customers, they're going to be partnering with Facebook in order to do payments through their WhatsApp system. So that's going to be a place where Facebook can also start to generate revenue in the payments industry. And I think that that is just going to be the beginning of some of the moves that Facebook does with the huge cash pile that they have available for them. They are going to be able to make many significant investments in order to grow in that industry. And you might be wondering, why do I feel so confident that Facebook can be the company that can make good investment decisions in the payments industry? And the reason why is that it just comes down to their track record. If you look at their return on invested capital, which is a really good way for us to look at how effective management has been at making decisions about investing their capital, this has been consistently above 25%. So the 10-year average is about 21%, and that has grown to 28% in 2019. So management is getting more and more effective over time with their investments. And we've seen this play out in specific examples, such as their $1 billion investment into Instagram. So that investment was $1 billion, and recently it was valued for Facebook at around $100 billion. So that was a hugely successful investment. And with the huge cash pile that Mark Zuckerberg and the other executives have available for them and the lack of debt, I think that there's no doubt they will be able to use that money to continue to grow either in the advertising industry or into new industries such as the payments industry. And really based off those factors, so we have high single digit or low double digit growth in advertising, then we have payments and continuing to generate a 25% or more return on invested capital, I think that I can reasonably get to a cash flow growth rate for the next 10 years of somewhere between 10 and 18%. And with a 50% margin of safety for errors, that gives me a buy range of somewhere between $100 and $170 per share. Now, in terms of why I picked Facebook and not Google, and also why I didn't invest in both, is simply due to the valuation. So I think that Facebook had a much more attractive valuation. I think that their businesses are very, very similar, and I would probably hold the opinion that it's going to be very difficult to know which one is going to outgrow the other one. But investors are definitely showing that they believe that Google is going to be the one that is going to outperform, and as a result, it has attracted a higher stock price. So I probably would put some money into Google if its price came down to a valuation that was similar to Facebook's valuation, but at the moment it's about 30% more expensive than Facebook. So it is what it is. But I certainly believe that the reason why Seth Klarman invested in both is because it makes sense to make a bet on the digital advertising industry. And then it really just comes down to your valuation, and his valuation could very well be different to what I think about Google or about Facebook specifically, or about them combined. And you could also draw very different conclusions about whether you think these businesses can succeed over the next 10 years, as well as how much cash they can generate for shareholders. So I'd also love to hear your thoughts on Facebook and Google as an investment. So let me know down in the comment section below, and I'll be responding to questions and comments as this video goes live. But if you did enjoy the video and you want to see more video content like this, then the best thing that you can do is hit the like button and hit subscribe so you can stay up to date. But other than that, I hope you guys have a great day, and I'll see you in the next video.